Question 41. Securitization is a process by which financial assets are purchased by an entity that then issues securities supported by the cash flows from those financial assets. Which of the following are the least likely primary benefits? An increase in the liquidity of the underlying assets. This is certainly a benefit. Rather than having to buy mortgages all one by one, for example, if we pool ones with similar characteristics all together, we can significantly increase the liquidity because there's less vehicles to trade there. B, an increase in credit rating from banks and other financial institutions. So when an entity is issuing these, they are moving them off their balance sheet, but it's more of a transfer of risk, and we don't know what the rest of their balance sheet looks like, so it's not necessarily going to be a slam dunk boost to the credit rating. So we can probably rule this out as choose this as our answer for not a primary benefit, but let's just take a look at C and make sure that one makes sense. A reduction in funding costs for firms selling the financial assets to the securitizing entity. It can reduce their funding costs since they're going to not have to account for these assets on the balance sheet. So we can go ahead and rule out C as well and say that B is not a primary benefit. Question 42. Which of the following statements is or are most accurate? A, the actual and 3360 are commonly used to calculate corporate and government bond days. So the actual and the 3360 are referring to kind of how these bonds are accounted for and calculated for the accrual purposes and interest. So B, the actual convention is commonly used to calculate days in government bonds, and the 3060 convention is commonly used to calculate days in corporate bonds. And then C, the actual convention is commonly used to calculate days in corporate bonds, and the 3360 convention is commonly used to calculate days in government bonds. So the correct answer is going to be B. Actual is used for government, and 3360 is used for corporate bonds. I don't really have any other advice other than that's going to just be something you have to commit to memory. So B. Question 43. The coupon reinvestment risk dominates market price risk when A, Macaulay duration is lower than investment horizon, B, Macaulay duration is higher than investment horizon, or C, Macaulay duration is the same as the investment horizon. So right away, looking at C, if we have a Macaulay duration that's the same as the investment horizon, that's what we want, essentially, to immunize our liabilities. So we can go ahead and cross that out because neither of these risks will be a factor for us because our bonds should be maturing at the same time as our investment goal. For this, we're going to be looking more at, if we're looking at corporate bonds, it'd be more so credit risk is what would mess this up. So we've got either Macaulay duration is lower or higher than the investment horizon. That's what we need to choose between. So coupon reinvestment risk is going to be an issue when our duration is lower than our investment horizon. So A is going to be our answer. And so just to kind of dig into that, when duration is, say, 5, but our investment horizon is 7, that bond is going to mature, but then we still have time to go before our final goal. So if the interest rates dropped and then we have to reinvest at those lower interest rates, that puts our goal at risk, essentially. And since we're holding the bond to maturity because our goal is longer than our duration, the market price risk really doesn't help us because we need the market price appreciation we would have got really doesn't help us because we need to be invested for that longer time horizon anyway. So when it would be B, where duration is higher, this is going to be when market price risk dominates coupon reinvestment risk. And that's because if, say, we're invested at a duration of 10, but our investment horizon is 5, if yields go up, that's going to hurt our price. And then because our bond isn't going to be maturing by the time we need the money, we could be forced to sell our bonds at a discount, which would hurt our returns, obviously. So, long-winded answer. Hopefully that made sense, but we'll go with A. Question 44. Which of the following is most likely a feature of revenue bonds issued by local and regional government authorities? All right, so A, they're used to finance the general objectives of the region. So this is what would be called a general obligation bond, or GO for short. And these are going to be issued for something that's not going to generate any revenue or not expected to generate any revenue, which goes against what we're looking at here for revenue bonds. So an example of this is going to be something like a school. It's not going to be generating revenue, so it's going to need to come from taxpayer dollars or some other source to be paid for or paid back for if we're issuing bonds for it. B, they are backed by the commitments of multiple national governments. That's going to be incorrect as well. Municipal bonds are not backed by the national government. They are issued by, like it says, local and regional governments, and those local and regional governments are obligated to pay them back. C, their repayment is often tied to user fees from specific projects they finance. So this is essentially the exact definition of a revenue bond. It's going to be tied to some specific project, for example, a toll road, where you're going to issue the bonds to construct the toll road, and then you're getting that revenue as people drive on the road, and that helps pay back the bond. So we've got C for question 44. Question 45. A repurchase agreement is most likely similar to an auction, a barter transaction, or a collateralized loan. So I'm going to pull this in here. I've got this little text bubble that I think kind of helps explain the mechanics of the repo agreement. So we've got two sides to this agreement. We've got the buyer and we've got the seller. So the buyer is going to buy the security. So they're essentially giving the seller cash for the security, and they're going to hold that security for the defined period, and then they release the security or essentially sell it back at the agreed upon purchase price. So when they're buying the security, they know what price in return they're supposed to get back. It's basically a short-term loan. And then the seller, they're selling the security and receiving cash. So then they're going to use the cash for whatever needs they have. And then usually they're using that to generate some more cash, which they'll need to then pay back for the security they sold at an agreed upon price. So this being said, key is that the buyer is holding on to that security and they're not selling it back. They're selling it back at the agreed upon price. So if the seller flakes out and doesn't buy it back, they have that as collateral. So, based on that, we can kind of go with C, collateralized loan. And, just to kind of get rid of these other ones, an auction, it would involve some type of bidding and, it doesn't mention anything. That's not any part of the repurchase process. And a barter transaction would be exchanging goods and services for another good or service, which is not what is happening here. So we go with C, collateralized loan. Question 46. Matrix pricing is most likely used for determining the price of, we've got new bonds, actively traded bonds, and inactive bonds as our options, and then A, B, and C are some combination of all of these. So since one is in every answer, we know that it will be used for new bonds. And just to kind of go over that quick, matrix pricing is going to be using bonds of similar characteristics to kind of derive or imply what the price of a bond should be. So if we are issuing a new bond, it's going to be helpful to use matrix pricing to kind of price that versus other options out there. So that one does make sense. But like we've talked about before on the exam, if you're crunched for time, seeing that the one is in all three of these is going to give you it's going to help you save a little bit of time if you can just cross that off right away. All right, so 2 actively traded bonds. This is likely not going to be used in determining the price or using matrix pricing, and that's because if a bond is actively traded, we're getting the market price for that. So we should be able to have the most recent quotes and what it's traded at recently. So we shouldn't need to use matrix pricing or similar bonds to do so. So we can go ahead and say we won't use it for 2 actively traded bonds. So that's going to lead us to cross out C since we've got 1, 2, and 3. So now we just need to determine whether it's 1 or 1 and 3. And then 3 inactive bonds. This is also a main use case for matrix pricing, basically for the same reasons we've already mentioned. If it's not trading super often, then we want to look at bonds that have been trading more recently to get an idea of pricing. So we'll go with B, 1, cross that off so you can't see it, but new bonds and inactive bonds. Question 47. In the event of default, which of the following is most likely to have the lowest priority of claims? So we've got A, senior secured debt, B, senior unsecured debt, or C, senior subordinated debt. So it's a little tricky here because they all have senior in the name, but I think what's going to kind of give it away there is the subordinated option, which is going to generally mean further down the claim spectrum. So we can go ahead and go with C here, and let's just pull this in for reference so we can see what the priority of claims are. So we're going to have first lien loan, senior secured, meaning it's secured by assets, senior unsecured, meaning it's not secured by assets. Then we've got subordinated below that. Then we've got subordinated and junior subordinated. So we can see that supports our answer for C. Question 48. For a 10-year 5% annual pay bond with a face value of $1,000 currently trading at par, the approximate modified duration based on a change in yield of 25 basis points is closest to. So this is our end formula that we're going to be using here for approximate modified duration. So up in the numerator here, we've got PV minus and PV plus. So we're going to take the difference between these two figures. So PV minus is going to be the price of our bond if yields drop by that 25 basis points. And then PV plus will be the yield if we increase by 25 basis points. So that's what that minus and plus down there means. And then we'll take 2 times that change in yield, which is going to be 25 basis points again, and multiply that by the PV currently, which is $1,000 since we're trading at par. So let's pull the calculator up and show you how we get those PV numbers. So essentially we're going to be solving for the present value under the 2 different rate scenarios. So for future value, we're going to have our 1,000, and then for payment, we'll have 50 since it's a 5% coupon. And then interest, we'll have 5.25 under the plus scenario. And then for N, we'll have 10 for our number of years since it's an annual pay bond. So we've got all those input. We'll hit compute present value. So we've got 980. So that 980 is going to be our PV plus number. And then all we need to do next is we're going to do 5% minus 25 basis points. So we'll take 4.75, make that our I, and then we'll hit compute PV again. So we've got 1019.54. So that's going to be our PV minus number. So we'll plug those in and then plug in those numbers below. So let me just pull in the rest of our answer here. So in the answer, we rounded up to 1,020. We had 1,019 on there and 981. And then input those numbers there that we had. They have the we have the PV and the yield just flip-flopped here. So the PV 0 is 1,000, change in yield is that 25 basis points. Gives us 7.8, so we'll go with answer B. Question 49. A 10% annual coupon corporate bond maturing in 2 years is trading at 100.75. The 2-year 8% annual pay government benchmark bond is trading at 100.95. If the 1-year and 2-year government spot rates are 2.4 and 3.5 respectively, stated as effective annual rates, then the G spread is closest to. So these spot rates here are going to be in there just to kind of throw us off. What we really need to do here to find the G spread is we need to find the yield to maturity on the corporate bond and then the yield to maturity on the government bond, and then subtract the two to get that spread. So we're going to be using our time value of money calculation here to figure that out. So I've got these numbers input starting with the government bond first. So we're going to have N of 2 for 2 years, and then we'll have present value of that 100.95. Make sure you put that in as a negative in order to get the right answer. Payment is going to be 8 for the 8% on the par value, which is 100, and then our par value is 100, as we just said, so that'll be our future value since that's what we're getting at par. From here, we'll hit compute in that I. So we know our government yield to maturity is going to be 7.47. So then from here, we're going to need to just plug those corporate bond numbers into our spots, and then we can solve again. So our N is going to stay the same at 2 years, so we don't need to touch that, and our future value will stay the same at 100 since the par value is going to be 100. But we do need to change the payment to 10. And then we'll need to change the change the current price to 100.75 minus, and then compute that I again. So we've got 9.57. So I've got those numbers written down over here. We'll pull it in. And so we see we've got 9.57 minus 7.47 gives us 2.1% or 210 basis points. So that'll be our spread, answer C. Question 50. A bond has an annual modified duration of 5 years and a convexity of 92. Given a 350 basis point increase in yield, the approximate percentage price change of the bond is closest to. So we've got minus 11.87, minus 6.23, and plus 9.52. So one thing right off the bat, we see we've got a increase, which is going to make the bond price decrease. So right away, we can go ahead and cross off C. From here, let's pull in our price change, and this is going to be the one that is utilizing convexity. So we were going to take our modified duration, put a negative in front of that. So we'll have modified duration of 5 or minus 5, and change in yield, which is going to be positive 35 basis points or 3.5%. Then we're going to add that to 1/2 the convexity, so 1/2 of 92, and then multiply that by the change in yield squared. So our 350 basis points is going to show up in there again. We'll square that. Pull in our answer here, so we do that math out, and we see we get minus 11.87%. We'll go with answer A.